alternate. And he's having, vast experience in this industry. I mean, so this his name is very well known in market. And with us, I think Manoj Mahadevan, who is the fund manager of Sundaram Alternate, I mean Sundaram RE Fund Real Estate Series 4. So I think Manoj is also there, right? Manoj Mahadevan.
I think he'll be
So
joining in. We both got into the wrong link, so I think he'll be
okay, no problem. So, sir, now over to you, sir.
joining. Thank you, Nishan. Thank you, Kakuli. Kakuli, in the meantime, if you could just ask Manoj whether he's able to log in, just in case he needs any help. And thank you for helping me out. Thank you, everybody, for this opportunity. I have heard of the FFF forum, and I've been in touch with Kanak also, so I know how prestigious this platform is, and I'm very grateful for you to have me here. And thank you for taking out time and coming out and listening to us. Uh, One of the things I thought I'll just talk to you upfront is, uh, you know, my experience spans both mutual funds and alternates. Bulk of my career, I have been in mutual funds, and I think since 2017, I am in the alternates business purely by default, not by design, if I may add. So some of the statements at times which I will make when I compare to mutual funds are coming from a point of view of simply data and interpretation of data rather than saying that this is better or that is better. So I thought I'll just give you an insight in terms of what we're going to talk about. Am I the host? Can I share the presentation?
Sir, I'll make you the co-host right now.
Thank you. If you can do that. We have a very interesting presentation for you. I will take up the first half of the presentation, and I will request Manoj to take up the second half. My mandate is to just wrap it up in 20 to 25 minutes, post which I think we can take questions. Yeah. Nishan, do let me know when you made me the host.
Sir, you are already the host now.
I'm already the host. Okay, shabash. Uh, I'm just trying to see how I can. Just give me a second. Can everybody see this presentation?
Yeah, it is visible.
It's visible.
Yes,
Is it?
it's visible, yeah.
Okay, great. Thank you. Just a couple of adjustments. Yep. So, real estate debt funds, this is an amalgamation of two words or the two asset classes, real estate and debt. And willy-nilly, both of them have been looked at with suspicion over the last few years. In fact, apart from equity, which has got maximum number of maximum amount of footage, as they say, primarily I think because of the investor education program in mutual funds, primarily because of rallying markets, and also the fact that there is general understanding of equity which is better. They say that there are a few things which every Indian claims to be an expert on: cricket, Bollywood, and equity. So that is why you'll find a lot of interest in equity. In some parts of the world, especially the East, the North, there is also a lot of expertise which people talk about in terms of real estate. Debt is few and far in between, and I think we look at debt primarily when equity is not doing very active. But my endeavor to you over the next 20 minutes is to share with you how things have started changing at the ground level and dramatically. So let me just give you a sense. Let me just lay the context for you. This is not just about real estate debt funds. That's around 10 minutes of the entire presentation. But let me just give you a sense of how things have been changing in India. Nishant, do let me know if some of the slides have been covered by some of the other participants. Then I will skip that slide. Yeah.
Sure. Okay.
I hope everybody can hear me, and I'm just going ahead. If somebody can't hear me, please do let me know. Now, one of the things which happens to a country when it crosses $2,000 per capita income is that we hear about change of habits. We hear about change of consumption habits, change of food habits. But what we don't realize is that there is a change in investment habits also. As the wealth and wealthy in this country are going to grow or are already growing, you will find that the way people are investing will start changing, will undergo an evolution. People will know more. As people understand and know more, the appetite for differentiated products starts growing. Differentiated would mean differentiated risk products, differentiated asset classes, differentiated geographies, because people would want to grow their wealth and try to explore more, especially since the advent of knowledge explosion which has happened because of the internet, more and more HNIs are aware of what's happening in the world. Now, let's look at the growth of wealth in this country. India is likely to have 150 unicorns by 2025. This data is slightly dated because it talks about 200 family offices. In the last 1 year alone, this number has gone up to 300. And, especially places like Calcutta, I think the number of family offices have grown manifold. There is a lot of money which is being raised by startups, and most of it is funded through, venture capital and the like. But it's projected that in the next few years, one third of the estimated 100 billion, which is expected to be raised by startups, will be funded by family offices. And these family offices have been created because of the generation of wealth in India. Indians themselves, if you look at the number of ultra HNIs and HNIs, ultra HNIs are those which have a net worth of more than 30 crores. HNIs are those which have a net worth of around 10 crores. It's $1 million. Ultra HNIs are expected to grow in this country. You're talking about people with a minimum net worth of 30 crores to grow by 40%, in the next few years. Close to 20,000 ultra HNIs would be there in this country. HNIs 1 crore and above will be, around 14 lakh HNIs, which will be there in this country in the next few years. And let's just see how it compares. But before that, how the transition of wealth is happening. Is it only in the top echelons? No, actually, the bottom of the pyramid is moving upwards. You look at the household GDP per capita in 2021 was $2,278. In the next 10 years, it's expected to be $5,242. This is GDP per capita per household. Okay. In fact, if you look at the household per capita household income, the way it is increasing, the percentage of houses which is moving into the $10,000 to $35,000 USD, it's 136% growth is expected in the next 10 years. Now, let's understand what is the significance of 14 lakh or whatever number, which in 2025 is expected to be 12 lakh millionaires. How dramatic is this impact? When China crossed $2,000 per capita income, the number of millionaires was 4,15,000. When we crossed $2,000 per capita income a couple of years ago, we were almost 80% higher than that. So that is the amount of money which is being generated in the system. Now, as money is being generated, like I mentioned to you, people's interest levels towards conventional products is becoming more and more basic. When you're talking about traditional products like insurance, pension funds, and the like, keeping cash in fixed deposits, etc., it's actually going down. And this is a survey which has been done by the Carvey Wealth Report. You can see that as the more an investment avenue entails knowledge, entails understanding, entails engagement with the investor, the more the growth is. So they're already moving towards unlisted equity, alternatives, and international assets, as I'm sure you all know about. Now, basically, if the wealth and the wealthy are growing, if the HNIs and the ultra HNIs are growing, we need to understand what do ultra HNIs want? What do HNIs and ultra HNIs want? Contrary to popular perception, when we believe that the more money somebody has, the higher his risk-taking capability is. Generally, when I've spoken to them, people keep saying that we'll give you money for long term, but just ensure that my wealth is preserved. I don't want any risk on my wealth beyond a point. I understand risk, but beyond a point, I don't want any risk. I take enough risk in my business in any case. But when I'm giving money to manage, I want my wealth to be preserved. Secondly, I want it to grow. I'm not looking at the 30% growth, 40% growth. I'm looking at a higher growth than nominal GDP growth. That's about it. So if you start digging further, and this is a survey which was done by IAAIF, the three primary things which HNIs want: creating new sources of alpha, they want to experiment; diversification, they want to go beyond what they're already investing; and capitalizing on emerging opportunities. The question they ask is, why can't we invest in a robotics ETF, which is currently in the US? So they're very well aware and they want to capitalize on emerging opportunities. Now, once you do that, then you realize, of course, there are two other things also, which is reducing overall portfolio risk and managing portfolio volatility. But the HNI and ultra HNI understands the risk. Okay, which is why the top three things which they expect is creating new sources of alpha, diversification, and capitalizing on emerging opportunities. In fact, 60% of the investors surveyed expressed interest for AIF offerings. Okay, but why? Why are AIFs becoming more popular? Number one, access to innovation. This is probably the only vehicle which can give you unfettered access and actual access to private equity, venture capital, alternate debt, hedge funds, whatever. And there are manufacturers who will create vehicles for you to access innovation. The second thing is non-standard treatment. Most pooled vehicles, large pooled vehicles, the treatment is same for even a 500 rupee investor or a 50 crore rupee investor. However, in an AIF, it's a very limited investor pool. You cannot have more than 1,000 investors in one particular AIF, which means that there is a very focused approach. The people who invest in an AIF are 1,000 people who completely understand what is going to come out of it. Access to the best minds here, because by virtue of the fact that you're investing higher sums of money, your ability to talk to the fund manager, understand it better, increases dramatically. Also, it is believed that some of the best minds are now migrating towards the alternates industry. More importantly, products which are curated on emerging trends can be created in a platform like AI. Is it happening only in India? Actually, no. Global alternatives are likely to hit $23 trillion by 2026. This is an ENY survey. It's a very busy slide, but what you can see is that in terms of different segments of alternate funds, every single one of them seems to be increasing. Growth in alternative AUM is expected to be at 11.5% CAGR over the next 5 years. It's currently 13 trillion. It's expected to grow to 23 trillion. More importantly, private equity and private debt are expected to grow the fastest. What's happening in India? In India, you will find, 5 years ago, less than 10% of high net worth and ultra high net worth individuals were contributing less than 15% in AIFs, which means that 5 to 15% of your allocation towards AIFs, if you would have asked, only 10% of the people would have said, this is what we do. 91% of the people would have said that we have 0 to 5% in AIFs. Currently, 5 to 15% is 1/4 approximately of the overall pie. And in the next 5 years, it's expected to be close to 60%. So 60% of HNIs and ultra HNIs, close to that, are expected to increase their allocation to AIFs. Not surprisingly, the number of manufacturers, people like us, have upped their targets in terms of raising money from people. Remember, you can collect only money from 1,000 investors per AIF. So at the very minimum, people are talking about 1,000 crores raise per AIF. This is slightly dated data. This is as of June 22, and I think it has increased since then. But if you look at the number of funds which have been launched, not surprisingly, CAT3. CAT3 is basically equity, more of equity funds, long only equity funds. So that has grown for the last 7 years. But if I look at the commitments raised across AIFs, that has been the highest in CAT2. Remember, CAT2 also includes private equity, but I was reading a slide somewhere. The private credit industry in CAT2 AIFs is already larger than the HNI component, HNI and above component of debt mutual funds. So that's a statistic which was startling, and I can share that with you offline later on. Let's understand what AIFs do in debt. It's not a conventional debt. We don't manage duration. I don't know whether anybody manages duration here, but basically it's credit. Okay. Now, if you look at the left-hand side slide, it talks about decrease in mutual fund credit. And we know the reasons why. My personal belief is that mutual funds is probably not the best way to play credit because it's an open-end platform. Credit is a largely illiquid asset. You have to pay an illiquidity premium, and that is why it is best suited for a closed-ended fund. But just because the decline in mutual fund assets has happened doesn't mean that the need for high credit risk funds is gone. In fact, it has gone up. That is because AIS has stepped in. It offers a more structured vehicle of getting into high yield debt. It's a SEBI regulated vehicle. It's monitored. There are tons of disclosures which are coming in. But more importantly, why private credit is expected to just grow. If India is to become a $5 trillion economy over the next 3 to 5 years, half of it has to come in through credit to support this growth. In fact, just across the credit spectrum, across various platforms over the next 5 years, one is expecting $50 billion worth of opportunities. H122, 7 new credit funds have launched in, I think in 2023, if my memory serves me right, close to 14 new credit funds have come in so far. What does that mean? Sorry. What does that mean for the investor and what does that mean for the borrower? Uh, let's talk about the borrower. Now, for the borrower, it is a very good market. The yields have decreased because more money is flowing in. 60% of investors believe that competition in private credit deals has increased over the last 12 months. Yes, it has, particularly in performing credit. In other parts of credit, it has not increased as much. Now there is more depth in the market, more options for borrowers, and more creative solutions which will come. Manufacturers like us have been very bullish on private credit as an asset class. In fact, almost 70% managers are bullish on private credit, turning to private credit, and it's expected to grow to 90%. A corollary to this is that if there's too much of money coming in, is there a sense of something consolidating, something going wrong? Only time will tell. But yes, with the proper risk management, you can probably, tide over any sort of issues which might happen, because remember, this is a close-ended vehicle. Let's talk about real estate debt. Am I audible? Any questions so far? Can I request you to just put your this thing on mute? Yeah. Thank you. Real estate credit AI, real estate AI versus credit opportunities funds, credit risk opportunity funds. It's just a very basic comparison which I've made here. When you talk about real estate, basically real estate is a micro market strategy. We are not talking about real estate investment in all the places. I'm not compelled to invest, for example, in Delhi and NCR if I don't want. More importantly, these are real estate backed loans. Okay, the underlying assets are real estate properties, building, land. In a debt mutual fund, it's usually government bonds, corporate bonds, etc. The return potential is slightly higher, whereas in debt mutual fund, there's relatively stable income. I will argue, and Manoj will probably talk about that a bit more, that income is quite stable, which is coming in real estate debt funds and performing credit funds. In fact, we have been returning almost 3% per quarter in terms of returns distribution to our investors. The risk profile is moderate to high. Why is it not very high? Again, because there are a lot of risk management measures here which Manoj will talk about. Collateralized assets, yes. In a debt mutual fund, usually you don't have collateralized assets. You just have bonds. Liquidity, why am I saying generally liquid? And why is it more liquid than debt mutual funds? Because here the platform is closed-ended, so if anybody has to read, anybody cannot redeem. Nobody can redeem. Okay, and if they do have to redeem, they have to just borrow against the units. Now I think there is dematerialization of units which has happened. So people who come in understand very clearly that they're locked in for 6 years, 7 years, 8 years. More importantly, they get this quarterly distribution, so that way the liquidity is managed. Diversification is pretty okay. It's broad diversification across users. In debt mutual funds, one might argue that there cannot be that much of diversification because of a variety of restrictions in privacy. Professional management is there in both terms. Investment horizon is medium to long term. I would argue long term. And yield is obviously higher. You pay a risk premium, so the yield is obviously higher in a real estate debt fund. It hovers more around 18%, but we like to talk about 16 to 18%. Let's just look at the real estate market since we're talking about real estate. And, this is a very busy slide, so I will just talk to you about some salient points. The extreme left slide is urban office market demand. The middle slide is urban residential market demand. And the extreme right is urban warehousing market. Now, if you look at, for example, the office market demand, it's flat currently. But what is expected is now with the economy having opened up in the last couple of years and people coming back to offices, the economy picking up, the demand for office spaces will start going up. That is one of the reasons why over the last 2-3 years, you find a lot of foreign funds which have come in and invested extensively in commercial spaces. In terms of residential, I think the demand is picking up as RBI goes slow on interest rates. In fact, looking at pausing interest rates, bringing down interest rates, this demand will go up. One important thing to see here is in this slide, which is the middle slide. I told you that this is a micro market strategy. Now you just look at the markets which have been profiled here: Chennai, Bangalore, Hyderabad, Mumbai, and Pune. The fastest growing markets are not Mumbai and Pune. They are Chennai, Bangalore, and Hyderabad, and they are leading the growth going forward. Okay. And of course, urban warehousing, the whole logistics industry is transforming. So the warehousing industry is expected to go through the roof because the logistics itself changing quite dramatically. You will be reading quite a bit on some of these real estate AIFs happening, but just to give you a perspective, till the ILFS crisis happened in September 2018. Remember, basically AIFs get into a regulatory arbitrage. What banks cannot do, banks are prohibited, or they cannot go beyond a point in terms of real estate financing. NBFCs also have to adhere to certain norms. AIFs have stepped in. But what has changed at the underlying? This is very important for you to know. Prior to September 2018, before the ILFS crisis, all the AIFs which are mentioned on the left were basically financing everything from land to construction finance to loan against property to refinance. That has changed dramatically post September 2018. So the latest players which are there, you'll find almost nobody is funding land, which means that the equity type risk in real estate debt has mitigated considerably. In fact, even if you look at LAP, which HDFC is doing, it is basically for completed projects, completed inventory financing, which is available at discount to market value. Otherwise, everything is either construction finance or refinance of existing AIFs. So the profile has changed dramatically. Couple of things which might be of interest to you. There is sizable overseas capital which is coming in. Co-investing by family offices had picked up dramatically. And today, transactions can generate around 18 to 20% gross returns in INR terms. We are also in the second bucket, and I'll explain to you a little bit more as we go. Before I hand it over to Manoj to take this forward, I just thought very quickly I will talk about Sundaram Alternates. I think Nishan mentioned about Sundaram Mutual Fund. We are a 100% subsidiary of Sundaram Mutual Fund, but we operate separately. In the sense that we have our own board, we have our own investment committees, we have our own strategy, we have our own teams, and we've been growing reasonably well. So very few people know that we've crossed 6,000 crores of assets under management, and we operate both in debt and equity segments. In fact, equity has been doing reasonably well as well. But since this whole discussion is on debt, we thought we'll just bring about debt. In terms of AIF category 2, real estate, we've got some serious vintage. In fact, we are the only fund managers in the country where there has not been a single default. And remember, the first fund was launched in 2018. It has gone through GST, RERA, COVID, and I would credit the fund managers who have adopted a very prudent sort of an approach to investing. Also, the fact that we have greatly benefited from the ecosystem of Sundaram Home Finance, which is present in the nook and corner of the country. Recently, we opened a corporate credit opportunities fund in performing credit. It's already closed. We collected around 1,100 crores there, and we've greatly benefited from the knowledge and ecosystem given to us by Sundaram Finance. The DNA of Sundaram is credit. Sundaram Finance is the only AAA rated NBFC which has been around for quite some time. We've actually never gone back to the market to raise money through equity. It's all been done through internal accruals. The category 3 funds in equity, that's just a snapshot. We also have PMS and of course advisory services wherein we advise domestic as well as foreign investors. I will ask Manoj to now take over. Manoj, would it be okay for you to take over from here? This is about your funds.
Sure, sir. Do you want to make me the co-host? I can move the slides.
Okay, I'll do that. Till the time I do that, you can just start off.
Yeah. So, hi everyone. See, I just want to touch upon what Mr. Vikaas had, highlighted in a few slides earlier, right? So, I think 4 or 5 slides earlier, he had mentioned the inflection point for AIF need for AIF to actually come in and come up with some structures where we can take kind of step in with and find a niche area and grab those opportunities. So our first real estate fund was born out of one such need. So like Mr. Vikash pointed out, in 2000 there was a slide which mentioned prior to ILF's crisis and then post 2018. So our first fund was actually raised in 2018. It was born out of the NBFC crisis at a point when a lot of financial institutions actually stopped doing different many structures in real estate. One of the important component that they stopped financing was funding projects at a land stage or funding land acquisition projects. Second, credit got tighter, so the underwriting policies of different institutions got much stricter. So a lot of projects got into a situation where funding for liquidity became, funding for their construction, liquidity became a big issue. And third is that the RBI came down strongly on the provisioning and funding, end use for some of these some of the structures that they're getting, the banks were funding against. So RBI really clamped down on that and brought in a lot of regulations. So a lot of the NBFCs lost their flexibility and had to kind of move out of or restrict their real estate portfolio or the funding opportunities or the end use of their funds in the real estate space. So it gave so the AIF really had a from that perspective, there was a real need for AIFs to kind of step in and take grab that opportunity. So that's when Sundaram Alternates we launched a first real estate fund in 2018, and we raised a first fund of about 400 crores. Subsequently, we've been able to raise another 2 series, Fund 2 and 3. Currently, what we're talking about is Fund 4. So if you look at it from a track record, we've raised close to about 1,500 crores. And most of this capital has gone towards projects in the south of India, Chennai, Bangalore, and Hyderabad, where we as Sundaram Group have a strong presence. So from a underwriting policy, we've tried to restrict our portfolio to mainly to the residential real estate. Again, tying in with the broader sector trends, where the commercial real estate was going through a certain lull, more a long-term play. So we wanted to get into a segment which is self-liquidating, and then from that perspective, we identified residential real estate to be a sweet spot. So among residential real estate, we've done different segments under residential real estate, be it villas or plotted development or even apartment projects. Typically, our fund, fund tenors have been for about 5 years. So keeping that in mind, we've restricted all our investments to about 4.5 years. And typically, when the fund life runs down, we've churned that capital to newer investments with a shorter tenor. So the track record has been pretty good till date. That's good. We've managed to hit about 19 plus IRRs across our portfolio, in all of the 3 portfolios, in fact, and which is translated into an investor IRR of about 15+% in Fund 1, close to 17% gross in Fund 2, and then similarly 17 plus in Fund 3. So I've touched upon the fund tenor as well, and in terms of how many deals that we've analyzed and deployed, it's about 40. The slide is a little dated. We've deployed over 44 deals till date, and I think we still have some pipeline where this number might go higher. A lot of churn is happening. So as on date, our Fund 1 is closed. We've returned all the money to our investors. So you look at it, there's 133%, DPI, so that distributed to parent capital. So if 100 rupees is invested by the investor, we've returned about 1.33x. So you can take that as a kind of a figure. And the other two funds are still live. We still have about we still have another a little over a year and a half in fund 2. So there, I think in the next quarter or so, we're just slowly starting to return capital to our investors. And fund 3, we're fully invested, and whatever money that is left there is like more from repayments. So there'll be a lot of churn there, which will only go to increasing our investors' IRR. So the managed account advisory is typically deals where we've identified and been able to place it in our affiliate company, Sundaram Home Finance, where we kind of earn an advisory income. So there we've been able to do some deals as well. So that's what you see in the 4th column.
Manoj, I'll change the slides. You're already co-host, but I have the
Sure, sir.
so I'll change the slide. Should I go to the next one?
Yes, please. So this. So any high yield credit, right? The success of any of these high yield platforms is dependent on multiple pillars, right? One is identifying the right project, understanding the risk, underwriting the risk correctly, and pricing it such that we're compensated well. Of course, the platform scalability of the platform comes into play, and the strength of the sponsor. So how we do it is through the below points, where so finding the right product and pricing it, understanding the risk and underwriting the risk effectively happens through a very experienced team. So we are 2 fund managers, and under us there are 4 credit managers, ably supported by additional operations team. So we we have over 50 years of experience cumulatively, which helps us, so we come in with sufficient real estate experience, and we are able to leverage on that. So it helps us identify the right kind of clients, structure the right product for the fund. And what also aids us is a very conservative credit policy. We have a very strong IC team. IC team is comprised of leading industry veterans. So Mr. Vikaas is part of a committee. He's an MD of Sundaram Alternates. We have Mr. Karthik Atreya, who's a head of strategy, who comes in with significant experience in real estate. He was heading Altico at one point in time before coming and founding this the real estate fund. We have a vice chairman, Mr. Harsha Vijay, also on our investment committee. And then we have MDs of Sundaram Home Finance and MD of Sundaram Finance, 2 gentlemen, Mr. Lakshmi Narayan and then one Mr. Raju, both on our IC committee. And then we also have a CFO, group CFO, Mr. Ramaswamy. So they are all highly experienced individuals, and the policy is very robust. So any proposals that we actually put across to the committee has to be unanimously approved. Only then anything passes through the committee. And how we structure the product as well is like, these are all senior secured deals. So, the fund has primary charge over the assets, primary charge over the exclusive charge over the asset and the cash flows. So any funds that we lend is always secured by at least a minimum of 2 times, with a minimum of 2 times security. So if you lend 100 rupees, the security is at least 200. So that kind of and these are some of the policies that are written in stone. And the differentiating factor between us and some of the other competitors out there is that all our investments are backed by cash flows. So we take a lot of comfort from cash flow generating assets as compared to taking any exposure only at the land stage because because that puts investment, opens investments to a lot of regulatory risk. So anything at the land stage goes through multiple channels at the approval. When it comes to approvals, you have land conversion, you have to go through getting approvals for a project. So there is a significant time lag between when you make the investment and when the investment starts generating cash flows. So that could throw up a lot of risk. So in case there's an unstable government, or if there's a churn at the approving authority level, so a lot of things can put the approval process, into a, actually put it into a freeze, and can significantly delay the project cash flows, project from being launched and then generating cash flows. So we kind of overcome that by ensuring that we underwrite projects with approvals, with cash flows, allowing for some takeout for expansion, where the money can be utilized for land acquisition or signing new joint ventures. However, any of these structures are supported by cash flows of an ongoing project. So that's how we try to minimize our risk. And pricing, of course, we try to target anywhere between 18 to 21% IRR, so that our investors are also compensated for taking certain risk. In terms of the end use, typically I highlighted, some amount is going for. So since we take multiple projects, some of it is for ongoing projects, some of it for expansion. So that the need for funds from an AIF is for such a purpose, where we can try and take advantage of the the areas which NBFCs or a bank cannot get into. So so we try and play that role and price it accordingly. Talking about our sponsors, our sponsors are Mutualfunds Finance. So till date, across our 3 funds, all our sponsors have contributed minimum of 15% towards capital. They've contributed minimum of 15% towards their capital. And as a good, when you take it in total, when you bring in all the affiliates into the picture, so there are some deals where we they come in as co-investors. So this contribution percentage goes to actually 30-35%, which is significantly higher than some of the other funds that are there in the market. Like I said, the committee is hands-on, and so this has helped us to actually start from scratch. I mean, when our first fund was launched, we didn't have any history in real estate AIF space. So we started with a 400 crore fund, and we've been able to grow to 1,500 crore. And what you see, this number here has deployed over 2,000 crores, is actually the money that we've been able to churn. So the investments where we made, and then the money has come back, been able to redeploy that into newer transactions, and that has helped us deploy over this 2,000 crore kind of number.
I'll move to the next slide, Manoj.
Sure.
I think this is going to be an interesting slide if you would just cover it.
This is more about the underwriting risk, underwriting methodology, right? So I would like to make it simpler and talk about the pre-investment and then a post-investment basis, right? So when you talk about a pre-investment, how we look at any single investment is that, like I mentioned earlier, we don't take any single project exposure. So any of our investment is across multiple projects, project with cash flow, established sales, which will allow us to give a structure to our client where he can use some money for expansion as well. So all these deals have multiple assets. And then what we also try and add is that we try to diversify our investments across geographies and, even within micro markets, even within, markets across different investors. So we limit the exposure to any single investee company to about 10 to 15% at the overall, at the overall fund level. So, for example, in Fund 2 and 3 put together, we have about 1,000 crores of capital. So we limit Single borrower, so single borrower limit across funds is about 10%, and maximum cap, when you take cumulatively across funds, then it maximum allowable of about 15%. So, like I mentioned, exits from cash flow generating projects. So even if we give any structures, if we ensure that our payouts are coming out of projects which are already launched with established sales. I've already touched on the tenor. So our funds are typically 5 years with a lock-in for the investors. So any investments that we make is for less than, maximum of 4.5 years. And as a fund tenor runs down, we keep any new investments that we make always has that 12-month buffer. We are purely in the residential space, so we have been focused on South markets up until now. So Bangalore, Hyderabad, and Chennai. We've been focused on the residential space, and typically most of our projects are in the immediate suburbs. And the typical project size has always been the ticket size of wherever the projects are. The ticket size of each of these units have been between 50 lakhs and 1.5 crores. Because we found that in our research, these are the mid-segment projects when it comes to South of India, and there's always a large demand, and the inventory levels are much lower as compared to the high ticket or the affordable. So when I talk about affordable, these are housing units categorized as affordable, about 650 square feet, where generally about 35 lakhs, 40 lakhs, but we've seen that post-COVID, demand for such units has been, far less. So we try and go with projects and segments which are high in demand. Investment policy, touched upon it. Secured investments are always secured by 2 projects, minimum of 2 times security. That's a given. So these cash flows are, escrowed to us. We have complete charge of these escrows. So some of these points are actually post-investment. So on a pre-investment basis, let me complete it. So when we underwrite any deal, right, so we kind of get into the enterprise and we do a thorough check on the promoters as well as the enterprise. We look at the kind of projects that they've done in the past. So the minimum criteria for any investment has to be about 1 million square feet completed till date by the group. Promoters with significant experience in the real estate industry, clean track record, not only in terms of delivery, but also with RERA, with in terms of civil checks, and any even we go into the MCA filings and look at any defaults over there. So we ensure that we underwrite and we tie up with the right groups, right promoters. End of the day, it's the calls that we take are based on the promoters that we have a relationship with, so even though they're real estate companies. So these are something that we don't compromise on. So it's written in stone that they have to have clean record for us to even get into any transactions. And of course, once we get into the enterprise, we look at the ongoing projects. We look at the surplus that they can generate over there, the kind of lenders that they have in the track record. And we also do a due diligence on the receivables, and we ensure that there are sufficient receivables available for them to meet their future repayment commitments to these lenders as well, because that's a very important aspect. And subsequently, what we do is we pick and choose projects that we would like to underwrite and fund. Of course, these projects have to have established sales, sufficient surplus, such that our entire investment can be repaid out of these projects. Then of course the legal due diligence and all the technical due diligence. We outsource these parts to well-established firms. So when it comes to legal DD, we tie up with leading law firms in the country with significant experience in real estate. So we look at their partners, their experience, and which are the institutions that they work closely with. And so some of them that we work closely are leading firms like Amachan, JSA, Fox, to name a few, Indus Law. from the legal DD part. And then when it comes to technical DD, we we work with leading registered property valuers across cities. They kind of give us a sense of where the project is at. They do a thorough DD on the progress and the cost analysis as well. So these are the pre-investment DD that we do, and post-investment we have a so we are hands-on. We have a strong credit team. We monitor all the cash flows on a regular basis. On a monthly basis, we literally check all the ledgers. We go through the sales MIS, and we have a complete control of the NOCs that we give, the escrow, the cash flows that we release towards the project, as well as monitor the end use. Also, what we do is that we continue partnering with these vendors that we tie up with at the project level. So our technical vendors continue to monitor as a more from a third party report. They give us regular quarterly reports, and sometimes we do, prepone these reports if we, make it more monthly if we have to. So we have a complete control over all our assets, and we monitor them very closely, and we checking these RERA websites constantly to ensure that if there are any complaints at the project level, then we try and get in and actively work with the developers to resolve this and ensure that doesn't get escalated, so that comes back and affects our investment in any manner. We can go to the next slide, sir.
Manoj, I will just take the next couple of slides.
Sure.
Just in the interest of time. Basically, we are talking about the Sundaram Real Estate Fund 4 here. And just some key points. I think Manoj has highlighted quite a few things about a track record in real estate, across 2,000 crores of investments, across 44, 45 deals, 0 defaults, high skin in the game as far as the promoter goes. Each of our funds, the promoters are investing close to 15 to 20%. And that's quite high. That's quite sizable if you look at it from an industry point of view. But just to conclude, I think the core investment focus remains real estate. We take calculated bets in real estate. We are the sole senior secured creditor or sole creditor in most cases. We enter into profitable projects where the project is up and running, the sales have started happening. Our approach is more like a PE investor when we talk to the builder, but we're very stingy with cash. We're very like a python on cash, as is what is well. And we're talking about a focus on ESG. That is something global investors like quite a bit. So this is what Real Estate 4 is. Currently, we're at around 350 odd crores of AUM and counting at this point of time. Interest is coming in from insurance companies, high net worth individuals, and the like. That's pretty much what it is. Just to conclude what we spent or what we discussed over the last 50 odd minutes, I started by talking about the growth of wealth and wealthy in this country. I talked to you about how what HNIs want, what ultra HNIs want. A platform like AIF, why it is the most suitable to cater to an HNI, in terms of risk and return requirements. The growth of the alternate fund industry, splitting the growth into private credit. What is the reason why private credit is growing? Again, splitting it down further in terms of performing credit and real estate credit. And in terms of real estate, we talked to you about existing players, earlier players, and then we talked to you about Sundaram, wherein Manoj took you through a more granular version of how we mitigate risk, how we generate returns. It's both an art and a science. It's not as simple as it looks, which is one of the reasons why touch wood. I always touch wood when I talk about this, that we've been able to be as successful as what we are. So Real Estate 4 is currently open, and this was a complete encapsulated version of the Real Estate Debt Fund. I hope you enjoyed it, and if you have still have some time, happy to take questions. Okay, you could reach out to Kakuli in Calcutta, or Nishant, if you would like to collate these questions and send it to us. This is something which is one of the fastest growing segments of the AIF industry. Knowledge levels are still on the lower side, so we'll be happy to answer as basic a question as it gets. Please feel free to have anybody and everybody ask any question.
Good evening, Vikaas ji. Namaste.
हाँ जी कनक जी कैसे हैं?
Thank you so much. I was in another meeting, so was unable to attend this. And but I will be, or rather, many of us will also look at the recording for sure. Thank you so much for the time. And you have been an amazing speaker, amazing wisdom you carry with yourself. As you carry the energy in the cricket ground also.
Thank you, sir, for
Which
your kind
used
words.
to be. So really looking forward to that. So I'm sure each one of us present over here must have got a lot of clues. Many of them are doing AIFs and PMS, some of them not. So I think this is the right time to think and continue to have this also as a part of the portfolio, because clients, the way they are all becoming rich, so they are looking for something special, and that special can actually be taken care with this, all this, whatever you have been sharing, and the whole series is all about. So thank you so
Wonderful.
much.
Wonderful, sir. Thank you so much, everybody. Thanks for your time.
Thank you.
And
Thank you.
hope to be in touch. Thank you. Take care.
Thank you so
Bye.
much.
Thank you, everyone. Yeah.
Thank you.